Hey guys, back with another daily update video. It is Tuesday, June 23rd. It's about an hour after market close. It's 5:09 p.m. Eastern time. And taking a look at the big board here, just an overall, another sideways day in the market. You know, mix of red and green on the board. Looking at the big tech stocks, they're up about roughly 1% or so. Semiconductors were down. AMD was down 1.4%. Micron was down 2.6%. So again, very happy that I sold off yesterday when I did, because actually my shares were at 49.50 and Micron closed at 49.84. So if I had held today, I probably would have ended up leaving some profit on the table. So glad I made that decision yesterday. But even Intel and Nvidia all down yesterday, or sorry, down today compared to yesterday. However, kind of reversed. The financials were looking good today. Yesterday they were all red. Today they're pretty much all green or sideways in terms of Wells Fargo here. But just an overall sideways day in the market. And one thing I want to show you is if we take a look at the big index of SPY, the S&P 500. I mean, yes, it looks like it's up and down, but if you look at it over the past couple of days, if I zoom in, this right here is June 16th, right? And today is June 23rd. So for about a week, we've just pretty much traded sideways in SPY. I mean, if you look back, SPY's just kind of been going up, traded sideways, going up, kind of always going up and to the right. But for the past week, the volume on SPY has been very, very low, meaning not a lot of shares of SPY are getting traded in general, and it's traded very, very sideways. If we take a look at QQQ, the NASDAQ 100 ETF, NASDAQ, came up today, and people were speculating that's because people were getting out of other industries and putting their money back into tech stocks because, stocks like Microsoft and Apple are just booming. And I think Microsoft just hit all-time highs yesterday. And I think it's set maybe even newer all-time highs today. But so people are suspecting that's a sector rebalancing. But if you look at this stretch here from, again, about June 16 to yesterday, also pretty sideways as well with low volume. So it's making some people, including myself, very nervous in terms of, is this the calm before the storm? Meaning, is something major going to happen where we have a big rally up, or more concerning, a big rip down? If you follow futures overnight, you'll know that there was a big blip in the futures last night where the market tanked, I think like by 400 points, because somebody from Trump's administration tweeted out that the China and US trade deal was falling apart, and that immediately just sent the markets down. And then the same person tweeted back saying, "Oh, it wasn't that bad, or the trade deal is still on." And then the markets came right back up, and we're actually green by like 0.4% or something in pre-market. And in general, depending on where you had your money invested, in general we had a sideways to green day, especially if you're looking at tech. But just goes to show you that, quite literally one tweet just sent the markets plummeting. So that tells me that the market is very tenuous right now, and that one little thing could just send us into a free fall. Because let's say that was true, meaning that the trade deal, for example, did fall through. Well, we were already down a couple percentage points pre-market after hours, and we probably would have still just continued falling off a cliff all day today if that was a true statement. So that's what scares me, is that one, there's low volume, meaning nobody is doing a lot of trading. So in the back of my mind, I'm thinking, well, what do the big players know? What do the hedge funds and the institutions know that the small fish like myself don't know, right? They have way more money on the line, that there must be a reason why they're sitting on the sidelines. And that kind of scares me. But I was able to see an article that recently came out on CNBC, and that might explain why there's been such low volume over the past few days. And this has been going on for about 2 or 3 days now. And like I said, as I've been paying attention to the market for the past 4 days in terms of how it's been trading sideways, and for the past 4 or 5 trading days, it's really not done anything, meaning major moves up or major moves down as a whole. So let me show you this article that I found on CNBC. So here's the article, and actually if you go onto cnbc.com, it's right there on their homepage. you can see they were just published at 1:18 p.m., updated about 20 minutes ago, but it's titled, "There's a wave of selling estimated to be in the billions that's about to hit the stock market." So a very scary, very ominous title, right? And what they're talking about in this article is that, we're in the month of June, and specifically we're 1 week away from the month of June ending. And that's very important for two reasons. One, because it's the end of the month, and usually in the end of the month, people will relocate their assets, meaning they'll shift their money from one stock sector to another, like a rebalancing, if you will. But then the other thing is that since it's the end of June, it's also the end of the second quarter of the year, right? Because June is 6 months in. So not only would you have the normal monthly sector rebalancing, but you're going to have the quarterly rebalancing as well. So this article, if you read through it, just to do a quick estimate or a quick run through, they're estimating that something between $35 billion and $76 billion worth of assets could be sold off or rebalanced. And this article suggests that people might end up selling off their stocks and putting that money into bonds. So, if we have this massive, like tens of billions of dollar sell-off in the market, that's definitely going to send the markets downward. And it says right here, Wells Fargo is estimating that the rebalance into bonds could be the largest we've seen in 6 years. So, this was a very good article if you're interested in reading it, but they pose a lot of good kind of suppositions and throw out a lot of good facts, like the S&P 500 is up 21% for the quarter. So in 3 months, the S&P 500, or SPY, because it tracks the S&P 500, is up 21%. That's crazy. If you invested money 3 months ago, you would have made 21% on that money. You could just cash out now, and you would have already outperformed the average value that the stock market goes up for a whole year. So that's just crazy to me. And again, I don't see how we could, keep that going, because at that rate, so 21% every 3 months. So if we just take a rough estimate and multiply that by 4, are we really going to go up by 80% or higher over the year? That's just not going to happen, right? We're going to have to level off or have a dip at some point. So one interesting thing is that, JP Morgan analysts see about a $65 billion rebalancing flow from U.S. defined benefit pension funds. And they think that globally, there could be $170 billion that could flow from equities or stocks. Goldman Sachs is estimating about $76 billion in pension selling of stocks. And kind of one interesting sentence here is that it says, while we acknowledge the risk of a small correction in equity markets over the coming 2 weeks as a result of this negative equity rebalancing flow, we continue to believe that we are in a strong bull market in equities, and any dip would represent a buying opportunity. So, if you're a bull, you're going to say, great, let the market dip, let them sell off their stocks and put them into bonds, because that lets me get into stocks cheaper and I can keep riding the bull market up. If you're a bear, you're going to say, well, this could be the beginning of the next downturn. So, either way, that's kind of why I want to definitely be out of the market this week. And the month actually ends, Monday, Tuesday of next week as well. So I may hold off at least until the beginning of next week to see what happens in the market. Obviously this article is going to hedge itself, and it says, well, stocks could go up, stocks could go down. So, there's a paragraph in here that says, well, maybe this won't affect the market as much as we think it will. So they're just kind of playing it safe. But to me, it makes sense, right? If you have billions or tens of billions of dollars of money that's going to flow from stocks and into bonds, well, then of course the share price of those stocks or these index funds are going to go down. So just food for thought. Again, this is not financial advice. I'm not telling you what you should do. I'm just trying to provide you with my thought process and some of the articles and graphs and things that I've come across. So if we just want to go back and take a look at some of my stocks that I like to play, here's AMD. You see it opened up green, had a very strong dip within the first, 25-30 minutes of the market opening, rallied back up hard up to the green by noon, and then slowly just sold off all day long where it opened up red. So again, I don't have any current positions open on AMD or any stock for that matter, but if you were wanting to open up a put, because AMD opened up in the red, it would have been a good day in theory to do it. And just to do some quick math, let's just look at what the puts were going for today. So because AMD was dipping down, the puts premium went up. So, the premiums on AMD this week just aren't that great. You would probably have to get in at the $52 strike price to collect a 0.4% return on your risk. Let's just say $27 divided by 5,200. Yeah, 0.5. And I think this probably would have been a little bit too low because the premium is not that great. But let's just take a quick look at the volume. So, a lot of volume. So, total of 3,600 of this option were traded today. And there's currently over 8,000 contracts that are open. So, still a lot of good volume on at least this option for AMD. That makes sense because AMD has always been one of the more popular option stocks. So let's just take a quick look at the graph for AMD. So, if we just go back from, let's say, June 16th again, just a very up and down, up and down, up and down, sideways day for AMD. If you look at the past few days, you can see it goes up, goes down, goes up, goes down, goes up, goes down. So today we're on a down day right around here. So, in theory, you could say, well, maybe tomorrow we're going to bounce right back up again. So it may have been a good day to sell puts or buy some stock and do a quick run up from like $54 to $55, make a quick dollar per share. But like I said, we'll see. But I'm probably not going to open up a option position. Maybe I'll try and scalp some premium. Maybe I'll try and swing trade AMD tomorrow if my kind of little thesis here is true, where for the past few days it just goes up and down. Been trading in a very tight range between about $54 and $55. So if AMD wants to run up by $1 per share, let's just say I just buy like 100 shares, I'll take a quick $100 in a day or so to swing trade it. One kind of caveat is make sure if you are going to swing trade or day trade, you don't violate the PDT rule where you have less than $25,000 in your account. So that's one of the advantages of starting with $25,000, as long as you don't lose that money, is that you don't have a cap on the number of day trades you can make in a week. So just a little kind of aside there. So let's take a quick look at Micron here, another stock that I was fortunate enough to sell for profit. So Micron just opened up in the red, dipped down, and just traded sideways. So another good day if you wanted to open up another position on Micron. Let's just take a quick look at what the puts were going for. So the puts on Micron, or at least the premiums on Micron this week, were better in general than they were on AMD. And that's going to be due to Micron having earnings coming up on Monday. So that's why there's a lot more volatility in Micron, so the premiums are higher. So again, I typically don't like holding options through earnings because typically the volatility drops significantly after earnings, and so you can lose money simply by what they call IV crush or implied volatility crush. So, if you did want to sell or open up a position on Micron this week ending Friday, it would be, in my opinion, and again, not financial advice, a good option just because you would collect more premium than you would on any other week for Micron that's not leading up to earnings. So let's take a quick look at Disney. What did Disney do today? So kind of had a little bit of a rally, right? So yesterday we closed at around 113, or that's actually June 22nd. Yeah, we rallied up, and then June 23rd, we kind of traded a little bit sideways here. So at least we made up some ground from its lows of like 112, 113. So looking at the past few days, this 112, 113 level might be a little bit of a support there because it tried to get down to that level and came right back up. So just interesting. Again, we're kind of very close to this Fibonacci level here. So maybe Disney wants to trade in this kind of olive green area. So maybe we're going to have a little downturn. Who knows? Still haven't had any news about them delaying their parks reopening. So, that's still kind of out there in the ether. See if that comes true or not. And we'll see how the stock reacts. And lastly, let's take a look at IWM, the Russell 2000 ETF. So had a kind of a very, again, sideways day. It was only up about 0.4%. Disney was up 0.6%. So again, pretty sideways for those two stocks. It's been flirting in this kind of light blue Fibonacci level between 78.6 and 100%. It kind of tested breaking down below. It didn't really like that, so it came back up. So maybe IWM does want to trade in this level right here with kind of a support at around 141. So just food for thought if you were to think about opening up a position. But again, I'm going to hold off just because what happened after hours was very scary. And actually, as soon as it happened, if you were on Reddit or Twitter, people kind of just lost their minds that the market just dipped so quickly and so suddenly. So that's why I'm very scared that if any like really bad news that is actually true comes out, that could in my opinion, that's what's going to set off the next big downturn, is that some like random or unexpected or very bad news is going to break that's actually true, and it's just going to send a market in a free fall again, because the amount of fear in the market is just going to spike up. Again, just my opinion. And I know there's been a lot of like doom and gloom in my videos lately, but I just come across these graphs and these charts on Twitter that I just find them very interesting, and I think they paint a more accurate picture of what's going on in the economy than what the stock market is doing. And there's just been a big disconnect between the market and the economy that just doesn't make sense. And I feel like, in my opinion, that the market at some point is going to have to correct itself and get in line with what's happening in the world. Before I get into those graphs, let's just take a look at what the most popular options were this week, or today, I should say. So Apple, again, number one. Facebook, Microsoft, a lot of tech stocks. AMD, right up there, top 5. Let's just see. Most of these were call options, about 78% compared to 22% on AMD. Here's a pharma company, INO. Maybe some news broke. I'm not sure why that one is so high today. But, as always, a lot of tech stocks. Here's Micron up there, pretty high up there in terms of the most popular traded option today. So, usually it's the usual suspects, right? Apple, Facebook. A lot of the airlines are up here right now just because they're cheap and people are trying to trade them, and kind of swing them for money. Some financial stocks, JP Morgan. So, here's Snapchat, here's Space. So I don't know if you know, but Space actually just signed a contract with NASA the other day. So I believe Space was up like 5% or something crazy yesterday. And looks like today it came right back down to earth. It was down 5%. But I think Space was up to like 17 and some change yesterday. So good news if you had Space puts on. If you sold them, I should say, not bought those puts. But let's take a quick look at some of those graphs I saw today on Twitter. So here's a chart. It's called .com Deja Vu, and I've showed a similar chart before in my videos, but actually today, or I should say yesterday, we are at exactly the same level where we were when the .com bubble burst. So here's, back in like 02-ish, 01, 02 is when we had the .com crash, or the tech bubble popping, and we are right back at that same level in terms of stock valuations. So again, this is based on the 12-month forward price to earnings ratio. So another ominous sign. One interesting thing is before the bubble popped, you can see it went higher, kind of came back down, was higher, and then kind of on the way down it popped. So maybe it's not going to pop right now, but maybe we're going to go up if the pattern repeats itself, and then we'll pop it on the way down. Who knows? But again, that's why I'm like on thin ice right now in terms of what the market is going to do. Here's another graph here. So this shows the total number of bankruptcy filings, and it is the highest number since it's been since May 09. So roughly since the Great Recession. So we are above, and these are, so it says liabilities of greater than 50 million, or basically 50 million or more. And you see this bar graph or bar chart is way higher than we have been in the past year or so, and it's the highest we've been in the past decade. So again, a lot of companies, both public and private, are filing for bankruptcy, which is again not a good sign for the overall economy. Let's take a look. So this is the website I found that you might find interesting, but it's called covidactnow.org. So it's www.covidactnow.org. And it kind of shows you stats state by state, and it's partnered with Georgetown, Stanford, and others. And you can see state by state how the states are doing in terms of COVID response. So if we just want to put an example of, let's just say Arizona, because Arizona is not doing so hot right now. So 7.3 million residents. If we go, we can see that the infection rate is considered high. It's 1.19 active cases, I assume, per day. Active cases are rapidly increasing at 1.19. So that means that on average, each person in Arizona with COVID is infecting 1.19 other people, which is kind of a very scary thought. That means everybody is infecting at least someone else. The positive test rate is almost 20%, which suggests that there might actually be insufficient testing. High risk of hospital overload. So that tells you that it's not looking good in terms of available beds in the hospital based on this website. And there's not that much contact tracing. It's only 1%. So, kind of scary what's going on with the COVID situation in Arizona. And actually we can look, county by county, the breakdown of, obviously red is bad and yellow is better, still not good. We want to be in the green area, but just kind of some interesting facts and figures that you can plug in your own state and see what we're doing. So let's just take another state, for example. Let's take a state that's not hit that hard. Let's look at North Carolina, just as a random state. So North Carolina is also not looking so good, although in terms of their ICU beds, they're in better shape than Arizona is. Let's just take a look at another state just for posterity. Let's go to Montana, kind of state up there. So Montana is pretty good, right? Their positive test rate is only 1%. Their ICU headroom used is low, which is good. And right now, they have a very good contact tracing stat. But they still have a high infection rate, or I should say medium infection rate at 1.10. So that means every person in Montana that is coronavirus positive is infecting at least a little over 1.1 person. So just an interesting website I came across today in case you want to look up your own stats for your own home state and see how things are going along. I don't think this is worldwide. I think this is only for the United States. So I'm sure there are other similar websites for other countries out there. And if you know, you can leave them in the comments below. Here's another article I came across, and this is called How the Robinhood Effect is Moving the Stock Market. And this is on the website Axios, AXIOS.com if you want to take a look at it. But this is an interesting chart I saw, and it's describing the change in institutional ownership of shares of stock. So you could look at this at two ways, meaning that the percentages are going down because more retail investors or people like you and I, the small fish in the pond, are buying these stocks, and or the percentages are going down because institutions are selling the stocks off. So that leaves a higher percentage for retail investors. So, we don't know, but it's also interesting because if you look at Spirit, it went from 111% down to 67%, which is a change of 44% over that time period. So you might be asking yourself, how does a number above 100% make sense? And they say that, shares exceeding 100% are usually going to be from a mismatch in the individual holders' reporting dates or double counting of shares that are sold short. So there's a little bit of fudge factor here. But in general, if you look at the airline sector here, cruise lines, and mortgage REITs, the numbers have all gone down from February 23rd to June 14th. So, there's multiple ways to interpret this data, and you could say, well, that's because the institutions are smarter than us dumb retail investors, and they're selling off their shares. Or the institutions haven't changed their positions at all, and there's been way more retail investors that have come in and kind of diluted the numbers down. So we'll never know, but just an interesting kind of data points here, where airlines and cruise lines, which I know a lot of new investors are kind of selling options on these and swing trading and getting these stocks because they wanted to buy the dip. And obviously these are people that may not have as much experience as these institutional investors that are dealing with billions of dollars and such. So just food for thought, because maybe it's right that these institutions know something that we don't, and there's a reason why they're kind of staying out of the game per se. And that could go along with, again, why we've seen very little volume overall in the market over the past couple days. So, just food for thought, because these institutions are trading with, millions or billions of dollars. So when they buy or sell large shares of stock, they're going to move the market. Whereas people like me or you, if we buy 100 shares, 200 shares, even 1,000 shares, we're like a blip, right? We're not even going to make a dent in the overall volume. So, you have to make your own decisions, but I'm very kind of nervous or scared about why there's been so little volume, because it feels like there's the calm before the storm. And maybe that storm is a sector rebalancing at the end of the month / quarter in June. So let me know, what your thoughts are. If you come across any interesting articles or graphs, post them below. As always, if you have any questions or comments, leave them below. And as always, happy trading.